nice and quiet of Easter, we have a very busy week coming up, with more than a fifth of the FTSE 100 Index's members due to report numbers or host their annual general meeting. They include Anglo American on Monday the 24th, BHP Billiton and Whitbread on Tuesday the 25th, GlaxoSmithKline, London Stock Exchange and Standard Chartered on the 26th, house builders Persimmon and Taylor Wimpey on the 27th, and big banks Barclays and RBS on Friday the 28th. Deep breath, but even after all of that lot, I suspect another bank is the name most likely to cause the biggest fuss in the week ahead, and that is Lloyds, which is set to release first quarter numbers on Thursday the 27th of April. The government's been busy selling down its stake in the high street bank to less than 2%, and there are suggestions the whole lot will have gone by the end of May, to finally fully return Lloyds to private ownership nearly 9 years after its 2008 bailout. It is possible this steady trickle of stock into the market has weighed on Lloyds' share price, which has sagged a little of late, as we can see here. It will therefore be interesting to see how Lloyds does once that selling comes to an end, although it is possible that other issues are also exerting an influence on its stock, including Brexit and whether it will be good, bad or neutral for Britain's economy, the UK housing market and whether it's overheating or already starting to cool, and how the Bank of England is keeping interest rates anchored at rock bottom lows, potentially hurting banks' net interest margins. Lloyds' first quarter results on the 27th will therefore be a good test, and all initial attention will focus on the headline operating profit number. A year ago, this came to £2.05 billion, and that's your benchmark for Q1 2017. Note, however, that net profit came to just £531 million a year ago, and as we can see here, the gap between quarterly operating profit and net profit has been very big, on several occasions going back to Q1 2013. This is because Lloyds' profit and loss account has been burdened with hefty loan loss and impairment charges, restructuring costs, and also litigation and conduct provisions relating to things like protection payment insurance or PPI. The next chart shows how all three of those have added up on a quarterly basis, also back to early 2013. If, and I stress if, these three numbers start to diminish and net profit comes in a lot closer to operating profit, allowing for tax, then Lloyds would look like a very profitable bank indeed, and this is one of the bull cases for the stock. If, however, you think the UK housing market's about to go pop and leave Lloyds a load of dud mortgage loans, you probably won't buy into that argument, even if PPI claims have an August 2019 cut-off. Skeptics may also point to how Lloyds is still shrinking itself back to health. As we can see here, loan growth and deposit growth have been nothing to shout about for some time, while risk-weighted assets on the balance sheet are still shrinking too. It should be worth checking out those trends for Q1 as well, although it's hard to see why Lloyds is suddenly going to start growing rapidly again, given that the UK is a very competitive, mature and tightly regulated banking market, unless Lloyds really pushes out the boat on credit card and mortgage lending and starts to take a lot more risk again. Underlying operating profit growth may well be modest going forward, and while headline net profit growth will be helped by lower charges and impairments and everything else, that's not really high quality improvement, so the real investment case for Lloyds may actually lie with its dividend. There'll be no comment on this until the interims in summer, but the consensus for 2017 is for Lloyds to hike its dividend to 3.5p a share from last year's 2.55p, including special dividends. That would be enough for a 5.6% yield on a 62.3p share price, a figure which may attract income seekers. Such a figure, if paid, would also exceed the prior peak payment in dividends per share offered by Lloyds since before the Great Financial Crisis. Lloyds' actual peak declared payout at the time was 35.9p a share, but there were only 5.7 billion shares in issue then. There are over 71 billion now, so if you adjust the pre-crisis dividends for the new share count, this final chart shows the like-for-like historic trend. Thank you for watching, and I look forward to seeing you next time.